Welcome back, legends. I'm Dr. Cal. This is a quick update video following up on yesterday's counter trend rally that we discussed. So let's get right into this video. This is the weekly stock market map, and I want you to pay close attention to a few pockets in the market. Notice financials, big banks, they're in the green on a weekly basis, and we're running into big bank earnings this Friday. Then notice utilities green, healthcare green in general. This is the entire healthcare sector, mostly green. Then look at this defensive telecommunications, also green. Consumer defensives, mostly green. What about the rest of the market? Consumer cyclical, so the risk on sectors, the bullish sectors, the growth sectors, they're all in the red with the exception of one stock, and that is Nvidia. So let's take a look at the different sectors. Again, yesterday we had a counter trend rally in tech, communication, cyclical. So the risky sectors, the risk on sectors that got hammered last week, they experienced relief, a relief rally Monday. But overall, the weekly look still remains exactly the same. Risk off, defensive posturing, defensive rotation, healthcare, utilities, and consumer defensives leading. And I'm going to cover financials for you today, the financial sector, because it is crystal clear what's going to happen with the financials. So let's get right into the daily chart for the S&P 500. Yesterday, I talked about these inverted hammer candles, double hammers, right? Red inverted hammer followed by a green inverted hammer. That usually means we get a short-term reversal. We got an outsized move yesterday. Massive 3 sigma move, but look at this on smaller than usual volume. I want you to pay very close attention, legends, to what happened in every pullback since the October bottom. Notice this pullback, right? Red pullback, the follow-up recovery day, the green day that follows, larger volume. Again, pullback, larger volume, larger green volume. Again, pullback, larger green volume the next 2 days. Recently, that hasn't happened, right? We had very large red volume as the market was topping in late December. That continued. Red volume outweighed green volume. That means big money players were actually exiting positions. We saw that, and we closed most of our long positions as the market was topping in late December. So what's happening short term? Double inverted hammers, short term recovery. We were looking at a rally all the way to 473. We overshot that by about $1. Let's take a look at the hourly chart. This was the clear resistance level at 473. Rejected once. Now we've broken through. So the next level to look at is 475.4 to fill this gap. However, this is a huge single day move. So it is very possible, legends, that we will open in the middle of this huge move. That tends to happen sometimes when you get a huge green candle like this. Sometimes we tend to retrace back to the middle of the candle and then get another push or attempted push higher. For example, take a look at this candle, huge green candle, retraced back nearly to the middle of the candle. And again, same look here, red candle retraced back to the middle. So that tends to happen sometimes, including here, huge solid candle retraces back to the middle of the candle. So short term, very short term, we're still leaning bullish. There might be one additional day of upside. We're looking at the gap fill at 475. There are a few scenarios that could happen. We could open lower today, then get another rally to fill that gap. Another possibility is we could open near the close of yesterday, get another attempted rally, and then the market can stall here into later this week, specifically Thursday. Why Thursday? Well, because we have the core and headline inflation numbers coming out Thursday, PPI, Producer Price Index, coming out Friday, and big bank earnings also coming out Friday. So we have two major risk events this week: Thursday CPI, and Friday both PPI and earnings. Why are the big bank earnings a major risk event? Well, simply because the entire sector, the financial sector, is extremely overextended. It has now completed this very clean bearish divergence, Higher high yesterday versus the high in mid-December. Significantly lower high on the RSI. Significantly lower high on the PPO. In fact, the PPO had already crossed down as the sector was forming this bearish wedge. So it is crystal clear now that the financial sector is in fact topping out ahead of the key earnings reports coming out Friday. Highest likelihood outcome is something that looks largely like this Legends, right? Consolidation turns into distribution, sellers step in, step in, step in, then we get a breakdown and a sell-off. Again, double top with a bearish divergence, higher high on December the 1st versus November 10th, lower high on the PPO, lower high on the RSI, exact same look that we have now, breakdown, sell-off. What does that mean? Well, it means very short term. Again, that means within the next couple of trading sessions, we might get additional attempted rallies to the upside. We're looking at this gap fill for 75.4. Can it go higher? Yes. However, as we get into later this week, risk will once again switch to higher risk to the downside versus the upside. What does that mean? Does that mean we go short? No, that simply means it does not make sense for us to go long at this level simply because the risk to the downside is going to be significantly larger than the risk to the upside. If you want to keep up to date with all of my work and all of my analysis on a daily basis, you can join our trading community on Patreon. Simply click pay annually. If you want to go for the annual discount, then click join. It's about $35.75 a month, but you have to pay annually if you want this discount. If you don't pay annually, the payment will be automatically canceled. If you want to try the Discord community for a month, you can go for the monthly membership at $55 a month. You don't have to sign up for anything. These videos will always and forever be free. However, if you want up-to-date info, if you want to have access to all of my indicators, all of my charts, and if you want to know exactly what I'm buying, when I'm buying it, what price, when I'm selling, every single trade and investment, this is the only way to get access to all of that. Once again, Legends, thank you so much for your legendary support. So why exactly are we not going short? I covered this in yesterday's video. I'm going to talk about it again because it is crucial. This is the VIX up top, the S&P 500 down below in blue and black. I never go short unless the VIX breaks above the 50-day moving average and stays above it at least for 2 consecutive days. Where's the 50-day moving average? It is this descending green line. What happened the last 2 trading sessions? Attempted breakout above it. Friday, failed, rejected again Monday. Does that mean I want to go long? No, it simply means I will not risk going short because when these structures start to develop, you get a lot of chop. You don't make money going long, you don't make money going short. However, as we progress into later this week and deeper into February and March, risk switches entirely to the downside for the S&P 500 and the broader market, and significantly higher for volatility as we enter the earnings season. Remember, Legends, February, March, especially the mid-February to the end of March period tends to be historically the second most negative time of the year, seasonally speaking. February to March tends to be very negative. The most negative time of the year tends to be September to October. Second to that is February to March. And on top of that, we have the added risk of yields. Yields have been crawling their way up. We also have earnings coming out after a massive rally in the market. This is the S&P 500 down below in blue and black. Up top is the US 10-year Treasury yield. And recently we had a breakout above the 20-day moving average. So far we've been holding. We had a hammer candle yesterday, but so far yields have been holding. If yields start to break out again later this week, Thursday, Friday, that will inevitably mean that this relief rally will fail. In fact, that is the highest probability outcome from what we can see so far based on the longer term trend indicators, things like the put to call ratio, the CPC and the PC, both triggering a sell signal at the close of Friday last week. This signal, legends, has been accurate going all the way back to January of 2022. Whenever we had a sell signal trigger, we've always had sell-offs follow every single time, without exception, every single time. Even when we had short-term recoveries like what happened in late December 2022, right? The market topped on a closing basis. We got a sell signal from the CPC, that put to call ratio. The market ended up getting a false breakout, a counter trend rally, a bull trap, and it did not manage to hold. It tried to break out twice, failed twice, formed a double top, and then ended up selling off. So without exception, the sell signal ended up producing additional downside even when we got short-term counter trend rally attempts. And if we look at other long-term trend indicators like the McClellan Volume Summation Index for the New York Stock Exchange, you will notice that we got a sell signal last week. Sometimes these signals can flip-flop, right, like what happened back in June last year. However, when you get a prolonged uptrend like what we had since the October bottom, the sell signal that comes at the end of the uptrend tends to be a strong sell signal, a solid sell signal. By the NASDAQ composite, same exact look. Summation index crossed down Friday last week after a prolonged uptrend. The trend is switching, at least in the medium term, to the downside. In the very short term, we could still see some additional attempted rallies. Most likely outcome is that they will end up being bull traps, they will fail, and the market will continue lower all the way into the end of March. We're looking at 458 or so as the first level of support that we will likely hit this month or early February. Major level of support is at 440. We expect the market will retrace all the way back to 440 on the SPY by the end of March, and for another uptrend to begin between March and April. Now, I want to discuss some additional technical indicators that I did not talk about yesterday. This is the high-low index. And what I want you to notice, legends, is up top is the S&P 500. This is the high-low index. Below that is the net liquidity in the market. When you get these red readings from net liquidity, it usually means we got excess net liquidity, excessive net liquidity, excessive bullishness. We tend to see these readings when the market is in a strong uptrend, and we tend to see the high-low index begin to turn down as the market is topping, right? And in fact, if I measure from the first red to green switch all the way to the top of the market, that was exactly 50 days. If I do that here as well, first red to green switch, and I look at the first 51 days, puts us squarely in last week's choppy trading. That means we are in fact now topping. Now let's take a look at the weekly SPX S&P 500 weekly chart. We do have a very strong green weekly candle. Look at this. We reversed the entirety of last week's sell-off in a single day. This is exceptional. This is very rare. It doesn't happen often. However, it did happen before, and I'll show you exactly when it happened. First, I want to show you what happened over the last 3 weeks. We had this tombstone reversal pattern, right? Green indecision at the top, red closed below the 5-week moving average. This nearly always confirms a top. Let me show you the last few times this has happened. This was also the late July top. Green indecision candles, couple of indecision candles at the top, massive reversal candle closed below the 5-week moving average. It confirmed the top. Again, let me show you what happened here. Rally indecision candles closed below the 5-week. It confirmed a top. Okay. Again, green candles indecision at the top, closed below the 5-week. It confirmed the top. Boom. Same exact look. Now, what I want to show you is what happens after the first weekly close below the 5-week moving average. Notice this was the first weekly close below the 5-week moving average. If you notice, the next week we did get a bullish engulfing candle, right? So this entire move was initially, it looked like this. The candle initially looked like this, a bullish engulfing candle. Then what happened? At the end of the week, We got a complete reversal, massive sell-off. What do we have at the end of this week? Two major risk events. Is a sell-off guaranteed? Absolutely not. However, we do have a major risk event, and we're now seeing the exact same setup. Bullish engulfing candle to begin the week after the first weekly close below the 5-week moving average. This did not happen once. It happened again. Let me show you when. Take a look at this, legends. Look at this massive red candle, first close below the 5-week moving average. What did we get? A huge bullish engulfing candle that initially looked like this. Initially, the candle looked like this, complete reversal candle to the upside. Then what happened? At the end of the week, we got rejection, sell-off. What do we have at the end of this week? Again, CPI, PPI, and big bank earnings. What's happening with the financial sector? It is topping, right? It is clearly topping. Clear bearish divergence after a prolonged uptrend. Momentum is rolling over. RSI has a bearish divergence. PPO has a bearish divergence. They're both rolling over. Momentum is screeching to a halt. The sector is extremely overextended as it is entering the earnings season. In fact, this has happened so many times over the last few years. We tend to get this massive rally in financials ahead of earnings, and then we get profit taking and a sell-off after the earnings. Again, case in point, take a look at this, legends. December all the way to early February, market was rallying, momentum was turning down, rolling over, rejected, sold off, got a massive sell-off. Again, look at this, legends, massive rally all the way to all-time highs in the XLF, topped early January, 13th of January, closed below the 5-day moving average, broke below the 10-day moving average, and that was all she wrote. Additional selling to the downside ensued. So far, the market has been hugging both the 10-day and the 5-day moving average. We got the first close below the 10-day moving average on January the 3rd. That is last Wednesday. That was the first warning shot that the market was in fact topping. We can expect some potential additional upside in the next couple of trading sessions. That means Tuesday, Wednesday, but then Thursday, Friday, it rolls around. That's when we have to be exceptionally cautious. So again, legends, very quick summary, summation index for the NASDAQ Composite and the New York Stock Exchange. Both have already switched from an uptrend to a downtrend after a prolonged uptrend near the highs. That usually means the market is topping. If we take a look at the 50-day breadth, it got into this extreme overbought condition in the 90s, rolled over, rejected, rolled over, rejected, and we're now rolling over yet again. Every single time, legends, it called the top without exception over the last 12 months. Top. Is this time going to be an exception? Maybe. Are we going to bet on it? Are we going to go long against the odds? Absolutely not. Would we go short here? Still, absolutely not. Why? The VIX has not yet broken above the 50-day moving average. So what do? Sometimes, legends, the best possible course of action is to do nothing. Just stay on the sidelines, wait for proper structure to form. We absolutely believe the market is topping. Why would we go long here? It does not make sense. Do we go short? It is still early to go short. The VIX needs to cross above the 50-day moving average. Very long term, looking at the last 12 months, the market is in an uptrend. The market bottomed October. It is still in an uptrend. It will remain in an uptrend until the VIX closes above the 50-day moving average. However, we are at the end of the uptrend, and we do believe the market is in fact topping. Very short term, looking at the hourly chart, 473 initially broken above it, closed above it. However, 1 day's price action is not enough to say that 473 has been confidently cleared, especially when we get a short squeeze day like Monday. We did expect a relief rally for a variety of reasons that I discussed in the last video. That includes the double inverted hammers, stochastic being oversold in the short term. We did get a recovery. It was a very vicious short squeeze. It overshot our 473 target by about $1.50. However, medium term and longer term trend indicators, as well as what's happening with momentum, on the daily chart, the weekly chart, what's happening with financials in general, especially as they begin to report earnings this Friday, all point to medium term. The trend is switching from up to down, and it makes very little sense to try and catch a rally this late into the uptrend, right? We bought at the October bottom. We rode it all the way to the December top. Why would we go longer? It makes absolutely no sense. Would we go short again? No, the VIX needs to clear the 50-day to go short. So what would we do? Simply be patient. Simply be patient. Sometimes, legends, the best course of action is to do nothing. Just be patient. Don't get trapped in a trade, especially when the market is in such a volatile time with risk events coming up the end of the week and throughout the rest of January, February, and March. Taking a look at the Fear and Greed Index, same look, legends. Market was topping in the middle of the summer last year as the Fear and Greed Index registered a couple of readings above 80. Pretty much same look, legends. Here the market is now in extreme greed territory, remains in extreme greed. We do believe the market is beginning to roll over, and we do believe that the period between now and the beginning of February will be choppy. Most of the selling we expect to start between mid-February and the end of March. That's most of the selling. Between now and early February, we only expect a lot of chop, then continuation down to 458. In February, we expect some counter trend rallies, reject at 468 once again, continue lower to 440 by the end of March. We expect a bottom at 440 by the end of March. Now, I want to close out this video by taking a look at the BPSPX. This is the bullish percent index for the S&P 500. In the middle, below that is the RSI for the bullish percent index. Up top is the S&P 500. What do I want to highlight? Well, look at this, legends. Whenever we get a reading above 80, the market tops. The market tops. How do we know the top is in? Well, we get an extreme overbought condition reading, and we got a cross below 70 on the RSI. It happened. It confirmed a top. We got a 3-month correction. We're now in the very late stages of this uptrend. The market is topping. We now expect about 2.5 months to 3 months of correction that ends in late March. If you find these videos helpful, smash that like button right in the face. If you watched till the end, I thank you very much. I hope you found value in this video. If you watched till the end and you did not enjoy the video, I still thank you for your time and attention. That's all I have for you today, legends. Thank you so much for watching, and I'll catch you in the next one. Bye-bye.